Perfect. So welcome everyone. That's going to be the review level 2 CFA exam. My name is Henrique Cezar. I've been teaching the CFA material for many years now. It's my sure intent that all of you here that are taking the exam next week pass this exam. Okay, that's why I'm doing this live here, to make sure that all of you are at least more or less good with the content that you're going to face. I'm going to give you my impressions of the exam. I'm going to give you what I believe you will face in that exam. And everything here is going to be what I believe. I cannot promise how your exam is going to be. Okay? I can't. Right? I wish I could. I wish I could predict the questions that you face there. Right? I can't. Right? If I was able to do those things, I'll be playing in Vegas right now instead of teaching. Right? If I have able to predict things, I can't. So we're going to have to do the best we can here. I'm going to try to use, again, my knowledge to narrow the topics that you need to focus, what you need to remember, what I think has much less chances to be present in the exam, things like that. Okay, so hopefully it's going to be useful for you. Any questions you may have, just feel free to ask in the chat. You can write, you can speak. Right? Like I said, this is open to my students from all over the world. Right now, I'm teaching classes in Brazil for Brazilian students taking the CFA, American students taking the CFA. If you guys want to share personal information or professional information, excuse me, on the chat, right, for networking purpose, feel free. Right? I'm not going to ask you to do that because the purpose is the review. But if there's an opportunity, then go for it. Right? You can do that if you want. All right, friends. So let's see. I'm going to start sharing a document that I prepared. There we go. And please let me know when you don't see what I expect you to see. Okay, so, all right. There you go. So this is all the readings here, friends. Right? All the readings on the level 2. You have 47 readings all the way to ethics. Okay, 45 to 47 is ethics. We're not going to cover that today. Okay, but all the 44 readings, 1 to 44, all the way to portfolio management, I want to cover today. Okay. Some in more extent than the others. And I hope this is going to give you a good idea of how this whole exam could play. Okay, you're definitely going to get item sets for each one of those topics. No questions about that. That's the rules. However, we cannot predict that, and you cannot assume that every reading will have a question on that topic. That's not the case. Okay, that's not the case. Right, I'm reading, for example, like equity. Look at the size. Look at how many readings you have. You're probably not going to get questions or any questions for 1 or 2 or even 3 of those readings here. Okay. On the other hand, you might get 2, 3 questions of the same reading. So just be careful with that. Is that possible? It's very possible that in alternative investments, all your questions be on private equity. All your questions on real estate. Okay, don't expect a mix of questions because that's not going to be the case. It could, but it doesn't have to. All right. So the idea is to focus on those topics that's my idea today. Right? Is to focus on those topics that I think that should be more important for you as a financial analyst with the CFA charter, and what could be expecting or will be expecting you on level 3. Okay, there are a lot of readings here that are level 3 readings as well. So we could make an assumption here that, well, maybe the readings here is to expose you to the knowledge, but not necessarily going to be tested on this level 2 because you're going to be tested on level 3. I don't know. This could be an assumption, a wrong assumption. Yes, it could. Could be a right assumption. Yes, it could. Right? So we have to make a judgment call if you're not able to memorize and read everything here. All right, so let's go. Reading 1, 2, and 3. I would say 80% of your QM exam, right there. Right? 80 to 85, definitely. Okay, so if you get 6 questions of QM, or less than that, around 5. Okay, then probably I would say 4 questions will be on linear regression, multiple regression, time series. Okay, 1 item set on that. Maybe 1 question on machine learning and fintech. Okay, maybe. Right? especially machine learning, my advice here to you is just try to understand the types, the three main types: supervised, unsupervised, reinforcing, and each technique involved, or which method involved under each one of those, right? So the Q corner, the trees, right? The variance, standard deviation analysis, etc. Take a look on that. I predict that one question, if on that one. Now, those three ones here definitely going to be there. I'm going to do a review for you now. All right, let's go then. Linear regression, multiple regression, and time series. Let's see how this looks like. Well, first of all, friends, okay, please make sure you know how to read the ANOVA table. That's what you have here in front of you. You have three components. Make sure that this is very clear, okay? Make sure you know what the R square is. Multiple R's, it's also, you can add, is the square root of the R square. So this is the correlation of the variables of the regression. This is the prediction power of the regression, okay? The adjusted R square is just, again, this in this case is the same. Most likely in the most case will be the same. It's just an adjustment done. Don't worry about that one, right? Observations is the number of observations in your sample. That number of observations minus 1 is the total on the ANOVA portion of the table. That's the table in the middle. Okay? This one is linear regression. This is single regression because I only have one variable here. Could be multiple regression, sure. A multiple regression, we will have, for example, 3 variables over here, okay? Or more, 4, 5, 6, you name it, okay? All right, so multiple regression right there. Try to understand, I don't know, maybe you're gonna have to complete the table, okay? Maybe you're not gonna have these numbers, those 2 numbers here. Maybe you're not gonna have that number there, okay? How do you compute, or maybe you're not gonna have those numbers here. But you're always going to have those. So remember, follow me here very quickly. Observations is 15. Total, the observation for the ANOVA table is going to be n minus 1, 14. Regression, DF, degrees of freedom, I need to count how many X variables I have on my regression. In this example, I have only 1. So I put 1 there. And this in the middle is just this minus that, 13. So in the case you have to answer a question like that, that's how you do it. Okay, continuing. Now, there we go. How do we get this MS? Okay, MS is for median. It's the mean, not median, but mean square is the average of this number in front. So you take this number here and you divide it by the DF. Okay, you take this number here and you divide it by the DF. Okay, and one divided by the other is your F. This divided by this is your F. There you go. This F is very large. So the significance of F, which will be the p-value of the F, it's considered 0. Okay, it's considered to be 0 because it's very, very tiny. All right, there you go. Explanation power of this regression is an excellent explanation power. How do I know? I can take a look on the regression explanation or residuals. That's number here. And if I divided that by the total, look at that. I get exactly the R square. So that's how you compute R square. Take this, divided by that. Now, excuse me, take the regression, you divide it by the total. That's the percentage of the variable Y explained by the variable X in this case, or variables X's if you have more than one. All right, good. Continue here. If you have any questions, please let me know. Otherwise, I'm going to go a little quick here because we have a review, all right? It's not teaching the topic, it's just a review of the topic. Let's go to the last portion of your ANOVA table. That's very, very important also for you to feel comfortable here, okay? For example, a couple of things you want to take a look right away. Take a look on the size of the t-statistics. What is the t-statistics, by the way, in the ANOVA table? Is the hypothesis, testing the hypothesis that either the intercept or the X variable or both are equal to 0. I need to test that hypothesis. H0, or capital H0, says that the variable X is equal to 0. Well, I want to test that hypothesis, and I want to reject that hypothesis, right? I want to reject it. The intercept and the x variable are both 0. I want to reject that because if I reject that, my linear regression is good. Therefore, what I do, I'll take the t-stats, okay, which is the coefficient minus 0 divided by the standard error, coefficient minus 0 divided by standard error. And if that t-stats is very large or higher than the critical value, you reject the hypothesis. You're going to reject any hypothesis where the t-stats is above 2. Okay, that's, you can memorize that. But when it's below 2, you're going to stop and you're going to have to read the problem and see what is the critical value for you to reject or to accept the hypothesis. And you're going to reject if it is your t statistics, your calculated t is higher than the predetermined t statistics for the regression. So the financial analyst or the researcher will say, okay, at 95% significant level with a t distribution, I'm choosing with the degrees of freedom that I decided 2.01 is my critical value. Any t-stats above 2.01, I will reject the hypothesis. Any t-stats calculated below that, I will fail to reject. Okay, there you go. Don't reject. I don't even need to blink. Another thing you can take a look is in the p-value. The p-value is if this number here is less than 5%. If this number here is less than 5%, why 5%? Because I can see here that the researcher used the 95% confidence level, which is most of the linear regressions out there use the 95. Okay, it's not standard. The financial analyst can use 99 if you want, but I predicted that the exam is going to follow kind of more real life. It's going to be 95%. So if your p-value is lower than that, okay, then you're definitely gonna reject any hypothesis. Oh, I've got a question here. Will be giving us the t-table in the exam. I even predicted more than that. I predicted the critical value will be given to you, not the table for you to look for. The critical value will be given to you. Okay, I definitely would say with a high probability of certainty that critical value will be given to you. In this case here, 0, 0. All right. Excellent. Yeah. I do not advise anybody memorizing tables, normal distribution, t-distribution tables. I think it's going to be a waste of your time. Okay. And another point, you're already being tested on that on level 1. Okay. This is level 1 question to see if you're able to locate the critical value in a table. That would be more a level 1 type of question. All right, friends, so that's it. Okay, I would say that this is a very good understanding of the table. So make sure that you have an understanding of the table. If this was multiple regression, the only thing that would change is that you're going to have more variables here. You're not going to have only the variable 1. You're going to have x variable 2, variable 3. Right? For example, if my model is using inflation, GDP, and debt to equity ratio to predict something about a company, right? My model will have then 3 independent variables. Each independent variable will have a coefficient, a standard error, a t-statistics, and a p-value. Every single one. Okay. All right. So that's the review for linear and multiple regression. What we want to focus, it's not on the table. Multiple regression, you want to focus on the problems. All regressions will have those problems, but those problems and those 3 problems that you need to know, they are listed on the multiple regression reading, which is reading number 2. All right. So very quickly here, make sure that you know the what is a heteroscedasticity problem. Heteroscedasticity is right here in front of you. This is homoscedasticity is when the error term, the distance between those little dots to the linear regression, to the line, is the same, right? Or very small, it's the same. So that's homoscedasticity. Okay. Now, when we have heteroscedasticity, then the error, the distance of those little dots to the regression line will vary, will be different. And then you have a problem because your linear regression, it's not accurate. It's giving too much errors as you progress. So that's a problem. If those errors are correlated, means they are increasing at the same speed or some kind of like the same, they have some kind of a correlation between the error term, then you're going to have another problem, the problem of serial correlation. Okay, serial correlation is one problem, heteroscedasticity, it's another problem. Okay, so you need to know how to detect. Well, how to detect heteroscedasticity? The best way to detect heteroscedasticity is looking at the plot, the charter plot here. All those dots. But you can also, that now is the possibility of open questions, right? Which of the following the analyst should use to detect if there is heteroscedasticity in the linear regression? A, B, C. And the answer will be then Bruch-Pagan test, okay? Bruch and Pagan test for conditional heterogeneity. That's the name of the test. You don't need to conduct the Bruch-Pagan test, by the way. I doubt it. It's not even explained it in the readings. So you don't need to worry about that. Just be comfortable with the names. There you go. This is to detect. And how do I correct conditional heteroscedasticity? Just make sure that you know the techniques we have out there. The robust standard errors computation, also called white corrected errors. Or you also have the generalized least square method. That's all I imagine you need to know. The names of the ways to correct that problem. All right, good. So that's it, detecting and correcting. Okay. Defining, detecting, and correcting for each one of those three problems. One of those is called heteroscedasticity. The second one, serial correlation. Make sure you remember what it is, how to detect serial correlation. Serial correlation, there's more chances to be in the exam because we use the Derby-Watson measurement, ways to find out, right? So for the Derby-Watson, okay, very careful with how to use the Derby-Watson variable, right? If it is equals to 2 or very close to the number 2, then you have no correlation, okay? You have no correlation between the error term. You have no serial correlation. You can totally assume that. Now, be careful now, because that's how the questions show up in the exam. You're going to be, if the Derby-Watson questions show up in your exam, you're going to be given a range, the DL and the DU. That's the lower bound and the upper bound of the Derby-Watson. If the number, when you do your test for serial correlation, and your number gets right in the middle of DL, DU, it's inconclusive test. Now, if it's below DL, you can say that there is serial positive correlation, okay? The closer to 0, the Derby-Watson closer to 0, you have positive correlation. The closer to 4, you have negative correlation. Now, if your number is higher than 2, then be careful. If your number is higher than 2, then it could be inconclusive if it's inside this range here. But if it's above this number here, 4 minus DL, DL is this guy here, then you have negative serial correlation, okay? So that's it. I hope you can remember that. I don't think that, I barely see this one, the 4 minus DU and the 4 minus DL showing up in exams and mock exams, etc. Mock exams I meant, not the real exam, because even if I haven't seen the real exam, I wouldn't be able to tell you. But in mock exams, right, this one here barely appears, but it's something that you need to remember. So remember, the magical number is 2, and the extremities are 0 and 4, okay? So sometimes you can just take a look. The Derby-Watson given a problem is 1.97. Oh, 1.97 is so close to 2 that you can immediately assume that there's no correlation. Now, if it's lower, higher, then you have to do an analysis, okay? That's serial correlation with the Derby, how to use the Derby-Watson. Derby-Watson varies from 0 to 4, 2 being the perfect number, okay? If your linear regression has a Derby-Watson of 2, you are fine. All right, how do you correct serial correlation though? If you have the serial correlation, how do you correct that, right? Well, then Again, you're going to have to be doing like a trial and error, like modifying the regression equation. So there's not really a method here that you can apply, right? You can just like, now you can adjust the coefficient of the standard errors. You can do like a more sampling. You can change, increase your sample. So that's the best way to correct zero correlation. Just keep doing, okay? Kind of like trial and error. All right. I don't think that's going to be a question. A question is going to be more on the Derby-Watson. Yes or no for the zero correlation in that scenario. All right. Third and last one, friends. Multicollinearity. Make sure you know what it is. Make sure that you know how to detect multicollinearity, and make sure that you know how to fix it, multicollinearity. Okay. Most likely, you're going to have to know how to detect multicollinearity. Multicollinearity is the relation, if there is a correlation among the X variables. So that only works for multiple regression. You're not going to have multicollinearity on a single regression, only on the multiple regression. Only those that have more than one X variable, X1, X2, X3, right? GDP, inflation, D ratio. I have 3 X's. Well, then I could have multicollinearity on those 3 or 2 of them, right? What it is, if they are correlated somehow, I need to detect that. Okay, how do you detect it if you have multicollinearity on your regression? Well, there are a couple ways to do that. One is to measure the correlation between the variables, okay, using a correlation test, a correlation calculation. Or you can take a look on the ANOVA table. So let's go back to that ANOVA table. If the R square is very high, the F stats is very high, but the T stats of the X variables are very low, right? The P value of the X variables are very high, then you have multicollinearity, okay? You have multicollinearity, most likely, if you have R square large, significant F, but insignificant T stats for the X variables, then most likely you have multicollinearity. That's one way to detect, okay? In the case, when you have the multicollinearity, how do you do it? You can do, excuse me, difference of squaring or square differences for the regression. You can change the regression, right? You can omit a variable of the regression. So again, and you have to do some also a trial and error to see it. So most likely, I believe that if multicollinearity is in your exam, you have to know how to detect it, if there is there or not. All right. I'm moving on here, friends, to time series, reading number 3. Okay? Time series is also possible that you're going to get a question. Okay. I don't think this topic is more intimidating than really is time series, I think. Okay. There's a lot of things there. But there are things that we can believe here. I believe that must be that you must know. That's super important, right? So what is a time series? A time series is not a linear regression. A time series is just or let me rephrase what I said. It's a linear regression, or it's a behavior of a variable through time. So time series has to be a time frame. Now, it doesn't matter if a time series could be, they could be very difficult to analyze for a long period of time, but a time series could be meaningful in a short period of time, okay? Or if the time series exhibit patterns, then the financial analyst can use the time series to come up with some kind of inference or some kind of observation, right? So time series are important for that. So what you need to be careful with time series, right, is the problems with time series. So I'm just going to write here very quickly, right? You need to make sure that for you to be able to study a time series as a financial analyst, what you need is to make sure that the time series is not a random walk. Okay? It's not a random walk. Because if it's a random walk, then I have no clue where that series is going. I have no clue. It's a random walk. And by the way, the definition of a random walk is that the f of xt1 equals x of t0. Right? Meaning that the best predictor of the next variable is the previous one, right? So, or y t0, excuse me. Or x at t0, it doesn't matter. Anyway, you got the idea, right? The next one equals to the previous one. Okay, I'm going to put y here just to be more consistent. There you go. So yt1 equals yt0, means the next variable that I predict is equal to the previous one I predict. That's a random walk. Okay, random walk is a problem. A random walk is a problem because you have no clue where that series is going to go. Okay, a random walk, couple of things to remember here. It is not covariance stationary. That's a random walk. So if you hear the word, if you see the word covariance stationary, remember random walk. Okay, if you hear the word unit root, imagine a random walk. Unit root creates a random walk. No covariance stationary creates a random walk. And those two are useless, right? A random walk is useless for the financial analyst. But, if it is not covariance station, you have two series in front of you, two series. They're both have unit root, or they're both not covariance stationary. So alone, you cannot study those time series. But if you could somehow co-integrate those time series, co-integrate, that's the key word here in the exam, co-integration. If those two time series could be co-integrate, then you can use it. There's useful for prediction, right? Maybe if I co-integrate two time series, alone they don't mean anything, but if one goes to that way, the other one follows, then it's meaningful for me. Okay, I'm going to give you a completely like impossible example in real life, but would be able to emphasize the example here. Imagine that you're analyzing two stocks. You're doing Home Depot, you're doing Lowe's, stocks that I used to trade when I was a stock trader. So that's why I put those ones here. Look at that. They are, let's imagine they are both random walk. Both are random walks, right? But if I could somehow find a co-integration of those two series, meaning every time the Home Depot go up, Lowe's go up, right? Then that's meaningful for me. That's an example of co-integration. I'm not saying that this is happening in real life by any means. I'm not saying that. I'm just using an example, okay? So that's the time series approach, okay? So get comfortable with those names, random walk, covariance stationary. What is the problem if it is not covariance stationary? Not covariance stationary is a random walk. Covariance stationary, then is not a random walk. Then I can study. Right? Unit root means that if the series is not, it is covariance stationary, most likely the series is also what we call mean reverse. I'm just going to put this name there because that's important. Mean reverse is when the series goes back to a certain level. So if the series is a very high, very above the mean, the average number, most likely that series is going to go down to that level at one point. That's important for a financial analyst, right? Trying to predict things. And if the value of the series is below the mean, eventually going to go up. So mean reverse is important. Now, the problem with the mean reverse is when a series has no mean reverse. And the test for that, you usually use the unit root. I don't know how many of you remember that one, right? You take the coefficient of the intercept divided by 1 minus B1, right? Remember that one? So if your B1 is the number that's multiplying the X variable is 1, then you have a 0 in the denominator here, and then this whole thing blows, right? That has no idea where it goes. So that's the idea about the mean reverse, okay? Well, unit root, covariance, all of those are words associated to the time series, okay? So one thing that I think could be a good idea is for you to associate the keywords for those readings, right? Linear regression, what do I expect to see on that? What do I expect for multiple regression? I expect to see the problems of regression. Here, I expect to see something related to the ANOVA table. And here, I expect to see something about random walks, unit roots, and the problems with time series, okay? And on the multiple regression, you should expect that one question that you have to replace the variables to find y. And be careful with the ln, ln of y equals a plus b, okay? X or something like that, right? That's a linear regression. where A is the intercept, right? B is the number that's multiplying the independent variable, and the X is your independent variable. But you have to do the log, the natural log at the end, right? Excuse me, you have to revert the natural log to find Y, okay? So be careful with those linear regression that has the log on it. All right, friends, I'm moving on. Okay, if you have questions, let me know, because I'm on the time constraint here. So this is supposed to be a review. So I don't want to go too fast, but I also don't want to stick in one point for too long. Machine learning fintech. Then again, I don't want to spend much time here, you know, because this is reading, right? It's more reading. There's not much tips or anything that I can give it to you as I thought I could give you here. So here just take a look on the types of machine learning, right? In the examples of techniques under each one. And hopefully, maybe no more than one question will appear in your exam. All right, moving on to economics, okay? Economics, I selected those pretty much 3 readings. That's all you have for economics, reading 6, 7, and 8. Currency, economic growth, and regulation. So I predicted that 85% of your exam is going to be on currency and economic growth. Those are the economic growth theories, right? Classic, neoclassic, and endogenous theory, right? And problem with currency. That's going to, in my opinion, dominate your economics exam. Okay, regulation is going to be more a theoretical, maybe one question. Now it's in the news, right? The collapse of the FTX crypto exchange, right? Well, one of the topics of regulation on reading 8 talks about the capture theory, right? When the regulation capture, now when the regulator, those that are paid by the government to regulate, to make sure that the financial market is not under threat, and the regulators are being captured by the company that's being regulated somehow, right? That's one of the points on reading number 8. This actually happened, right? Because the news is saying that one of the problems that could be happening, right, that could trigger the collapse of FTX is the lack of regulation, and most likely, I don't know yet, I don't know that, but could be that the regulators were not doing their job efficiently there because, I don't know, they probably were being captured, and this is in quotation marks, not capture literally, but capture means convinced by closing their eyes or something like that. Well, that's the reading of regulation, okay? So if you want to take a look, just do the problems at the end of the chapter, right? If you have time, just do the problems at the end of the chapter with the answers, right? So put side by side, put here the questions, the other side put the answers, right? And then look at the question, look at the answer. I think that's a valid way to study for that. All right, so let's focus here on 6 and 7. All right, so very important to remember, friends, right? That the triangular arbitrage type of problems, okay? So you could get one of those. So make sure you practice that. It's not too difficult if you really understand what you're doing. And that's what I tell everyone that when I teach this. Put yourself in the shoes of someone that's actually facing that scenario, right? A triangle means you're always going to have a currency in between the other two. Otherwise, you could go directly, right? So the triangular arbitrage, you're always going to have a common currency. And my example is the US dollar here, okay? So I have all of those per US dollars, bid and ask, okay? Now, if you are lucky in the exam, you're going to get the mid quote. You're going to use the mid quote, okay? The mid-market quote. Sorry about that. The mid-market quote. The mid-market quote means is the average of the bid and ask. So you're going to have only one. So that's usually easier problems. The most difficult problem with triangular arbitrage is bid and ask. Then you have to be careful, okay? Because if you're starting on a currency here, let's say I'm starting with the Great Britain pound, right? And I'm going to the US dollar, and then I'm going down to euros, okay? And then back to GDP for the British pound, right? If I'm going on, I'm doing that scenario here, okay? Like that. If I go to the GDP, now the British pound to the dollar, I use the bid or use the ask, right? If I go from the US dollar to the euro, do I use the bid on the ask, okay? So I like that rule, the up the bid, down the ask scenario. Look at that. If I'm going to the GBP to the USD, forget about, when I say up the bid, down the ask, I don't mean the triangle. I mean the quote, okay? I mean the quote. So look at that. Great Britain pound. For me to go to the USD, I have to go down the quote. GBP is on top, USD is on the bottom, right? This is GDP per dollar, right? SEK per dollar, euro per dollar, right? That's what the division sign means there. So that means that's how much I need to buy one of that. Well, if I have GDP and I have pounds and I need to go to dollar, I have to go to down the quote. I was on top, I need to go down. So I go down the ask. Now, if I have to go from US dollar to euros, my friend, US dollar to euro, I have to go up because the euro is on top and the US dollar is on the bottom. So US dollar to euro, I'm going to go up the bid. So I go on the bid, okay? And if I have to go from euro to British pound, right? Euro per British pound, you don't have that quote here. You're going to have to do the cross exchange. And then you have to see if you go up or down on the quote. Here, if I have to go from euro to GDP, if I have this euro for Great Britain pound, or I could have Great Britain pound per euro, okay? You need to see if I have to go from euro back to pounds. If I have this, I go down. But if I have this, I go up the bid, down the ask, okay? So I think that's very useful, and that's what I usually, I mean, I cannot tell if I got it right or wrong, the question on my exam. I couldn't even tell if I saw a question like that when I took the level 2, but I can tell you that that's the easiest way, in my opinion, to do a triangular arbitrage problem, okay? Practice that. I think that would work. There's several problems on the end of the chapter, the reading number 6, okay, for that. All right, what else? We could have carry trade. Look at that, the carry trade, okay? Another type of problem. I put here for you the basics of the carry trade, right there, okay? So the steps involved on a carry trade, okay? So let's see if we can see that, right? Oh, no, not the one. There you go. I'm gonna put this one, and I'm gonna put some color there to make it easier. Perfect. And so let's see. Step 1 of carry trade, you borrow the currency at the low interest rate at time 0, okay? So usually they give you Japanese yen on the examples we saw in the books, right? And euros, right? Then they tell that the interest rate in Japan is 1%, and the interest rate in Europe, right, in the Eurozone, let's say, is 5%. There you go. So you're gonna borrow at a low interest rate, and you're gonna invest at the higher interest rate. So the easiest way to do this problem is for you to borrow exactly 1 unit of the foreign currency, or 100 units of the foreign currency. That's what I usually do. So how many yens do I need to buy 1 euro, right? And then I'm gonna borrow that quantity of yens, use it to buy 1 euro, invest, right? Invest, okay, on the higher interest rate, wait a year, usually, or 6 months, whatever time is the problem give it to, usually is a year, wait a year, and then I will sell, okay, my hold investment, the investment that I'm holding, I sell at T1 in euros, then at T1, I convert the funds back to yen, then I'll pay back my loan, and whatever is left is my profit. That's a carry trade, okay? So that's important that you understand the steps how to do one carry trade and perform that. Let's see a question here. For me, the main problem is to identify the direction, what currency start the triangle. Oh, I'll answer that to you. It doesn't matter. It doesn't matter. It doesn't matter. I can put my British pound up here. I can put my US dollar up here. Now, what you need to know is where to start your trade, okay? Where to start your trade. So one tip here is that in the middle. So it's gonna have like the start currency. You're gonna have the mid currency, the one that you're gonna go pass through it, right? And you're gonna have the end currency. And then back to the start. That's That's what it is. So start currency. So look, what do I have in my hands? Okay, I have euros. Well, then that's my starting currency. What do I need? Let's say I have British pounds and I need euros. I cannot go in the market and buy the euros because that market doesn't have that. So what do I have to go? I have to take my British pounds, then go to dollar, and then go to euro, and then back to pounds. That's it. So it doesn't matter. It really doesn't. What it matters is this. That's what matters if you have the bid and ask in that problem. Okay, up the bid, down the ask. Doesn't matter if I start here. Look at that. I arrive at the same answer. If I have to go from British pound to dollar, and the British pound is all the way there in the triangle, doesn't matter. Take a look on the quote. It's the quote that you have to take a look. I have GBP per dollar. If I have GBP per dollar, I have to go down the quote to transform my GBP into dollars. Down the quote, I go down the ask. I go to the ask value. Okay, that's how it's done. Okay, so it doesn't matter which order you put in that triangle. Okay, no, it doesn't. All right. Okay, well, that's it for me. So again, of course, there's much more, right? By the way, understand that all exchange rates are quoted, right? The premiums or the Ford premium, the Ford discounts, right? Let's say Ford premium equals 3. What does it mean? Well, is that number, whatever Ford premium it is, divided by 10,000. Okay, that's the amount you're gonna add if it's a premium. If it's a Ford discount, minus 35. Then you're going to be doing minus 35 divided by 10,000. And that's the amount, I cannot do it here, but there you put it there. Minus 35 divided by 10,000, friends, 0.0035 is the amount that you're going to add into the quote if you need to get the Ford, or subtract in this case, because it's a discount. Ford's discount, Ford premium, okay, is done on the 10,000, okay? And 0.0001, 0.0001, okay, which is 1 divided by 10,000, okay, that's called 1 peep, P-E-E-P, peep, okay, so the PPs that they do, so each one is 1 divided by 1,000, just in case you see that vocabulary in the exam. All right, there you go, done. Make sure you're doing good declaring trade. I definitely would expect a triangular arbitrage question on your exam. Okay, it's like pension benefits on the FSA. Most likely will be there. All right, moving on here, the 3 theories, the economic theories. So make sure you really know the definition of the classic, neoclassic, and endogenous, right? What each one says and what is the difference of each one compared with the previous one. So what is the difference between the neoclassic and the classic economics, or the endogenous and the neoclassic, right? And more than that, right? Which one, right? Which of those theories talks about the convergence theory, okay? The member convergency, meaning the underdeveloped countries, if you adopt some economic policies, or developing countries, to be more precise, developing countries, right, will converge to the developed countries, right, according to one of those 3 theories. Which one is that, right? So that's the types that you need to know, or which theory, right, of those 3 says that capital deepening, that's a great word that shows up so many times in the reading, capital deepening, right? Capital deepening. It's a way to grow, they grow the output through capital deepening. So neoclassic, right? The convergence theory that I just mentioned also is neoclassic. But, okay, what is the endogenous? The endogenous is the one that neoclassic and classic predicts going to have an end. The output is going to grow to a certain point, and that's it. But endogenous comes and said, well, not really, because technology will always making sure that you're going to be able to increase the output, right? So it's important that you take a look on those economic theories. And don't forget your Cobby-Douglas formula, okay? I'm just going to put that one there. Cobby-Douglas formula for the output is important, right? Is the one that has all those multiplication factors, right? You have the TFP times the capital at the power, right, of, let's say, alpha, right? And then times labor, right, at the power of 1 minus alpha, something like that, right? And if you, that's the Covey-Douglas form. Try to understand the components, right? What is K? What is L? What is the TFP? Which is kind of, I think it's in the correct form is A, okay? But doesn't matter. What is A? What is K? What is L? What is this little A on the power of, right? That's the percentage of allocation between capital and labor. So that formula here, you should review. All right. And if you want to take a look on the regulation, if you have the time, I would go at the end of the chapter, when the reading 8, excuse me, go to the end of the reading 8, and I do all the problems, all the questions that I have at the end, looking at the answers if I don't have the time to do it, just to make sure that you cover this chapter here. All right, friends, moving on. Okay. Now I'm going to go to a topic that has a heavy weight in your exam, which is financial statement analysis. Okay, it's a heavy weight on that level 2. Okay, so important. Okay, that you really get as much as you can from the FSA. Now I can narrow for you, in my opinion, that's using my opinion here. I can tell you that the readings that you need to know, okay, is going to be 9, 10, and 11 for sure. 9, 10, and 11 for sure. At least one question I predict of each there. Reading 12 is an important reading, but it's a relatively new reading. I didn't have that reading when I took level 2, the financial institutions, okay? But since the crisis of 2008, financial institutions, this reading become very important. So you might have a question on that one, a question of financial institutions there. Now, quality of financial statements and integration of financial statement. Definitely the quality of financial statement, I don't predict any question on your exam because that's more level 1, okay? But it's important to reinforce whoever is studying for the CFA exam that the quality of financial statement, if you're GAAP compliant, IFRS compliant, right? If you're not doing, if you're using all the methods, accounting methods correctly, that's the quality of financial statement. That's level 1. I wouldn't say probably no chance to be a question on level 2. Again, my prediction. Integration of financial statements are the famous accrual. That's like forensic accounting, right? Kind of like going there and dig it in and try to find problems that kind of like make the quality of the financial statements not that great, right? Low quality or like non-persistent earnings or the low quality of earnings, etc. Right? That one, I predict maybe one question on integration of financial statement. Let's see. But definitely the other 3 there, absolutely. So let's see. All right, friends, so look at that. Intercorporate investments, okay? Again, it's a long reading. If you have, well, all of you is an exaggeration. Most of you have taken a class with me before or a tutoring session, a mentoring session or something like that, right? A mentorship session, okay? Whatever it is, right? I already explained to you for those that had class with me or some kind of session with me, that it takes a long time to get this, right? This is really, when I used to teach this in the university, it was like 2-3 weeks, right? Of classes, right? 3 hours a week just to kind of cover that in a decent amount of time. So again, I'm not going to be able to give you everything here in few minutes, but I'm going to try at least emphasize the important points. So let's go. Intercorporate investments. Remember that you have those 4 categories. I know the book, the reading usually talks about 3, but there are 4. Passive investment, investments that you have influence, a joint venture investment, 50-50, or a control investment, 50% plus 1 share. That's it. Those are those. Okay. Now, for the passive investment, how do I predict the question to be on the classification of each one? The classifications of the passive investment. There could be HTM, available for trade, available for sale. That's GAAP vocabulary. That's the names the GAAP uses. Or could be amortized at cost, fair value profit and loss, fair value OCI. That's the IFRS classification. Okay, but it's the same thing, the same logic. That's the good thing about it. It doesn't matter if it's IFRS or GAAP, as long as the name changes, but the logic and the accounting methods is the same. So that's good for the passive investment. So what you need to remember here, friends, if it's an HTM, it's amortized only. Interest rate is recognized on the P&L, right? And you just amortize that amount if you purchase a bond at a premium or a discount. That's level 1. So I don't predict that you need to know much about this. Hopefully you do. But if you purchase a bond, right, at a premium or a discount, then you're going to have to amortize that, right? So you're going to have to include the amortization in the income statement and the interest that received, because you're talking about investments, right? That's interest received, interest income. It's money that the company received, right? That goes to the income statement. AVT is available for trade. So available for trade is quick profit that the company expects to make in some investments. So any dividends, right? Any money related to the AVT is go to the income statement. Okay, income statement, profit and loss, taxable income here. Okay, now including the unrealized gain and losses. Pay attention, unrealized gain and losses, because every year you have to, not the HTM. The HTM you don't touch it. You don't do fair value, but available for trade, available for sale, you do fair value. Fair value every year you have to, it's going to increase or decrease. That change for the AVT is goes to the P&L, goes to the income statement. For the available for sale, be careful, that one is the tricky one. Available for sale, unrealized anything, gain or loss, goes to the OCI. And realized goes to the income statement. Okay, and the dividends goes to the income statement. Okay, so the only thing that you need to remember about the OCI under passive investment is that the unrealized gain or losses of the available for sale securities will go to the OCI. It's the international classification is better because the international classification tell you exactly, right? The name, like P&L and OCI. So you know.
Cara que eu tô fazendo junto à prova, né? Um amigo meu mandou para mim que tá tendo uma revisão. Tô vendo aqui a revisão, amor.
Ok. Eu peço a quem esteja com o microfone ligado que o desligue, por favor. Obrigado. Eu não tenho eu tô feliz com o número de audiência, mas eu não tenho como encontrá-lo. Obrigado. Continuando aqui então, friends. Okay? Look at there. AMC, fair value profit and loss, fair value OCI. Okay? So those are the names, but the logic that I just explained to you apply for either IFRS or GAAP. How the questions would show up? Classification, changing from here to here, what is the impact on the income statement? If I change from AVS to AVT, what happened, right? Could be an impact on the ratio. What happened to a particular ratio, right? If you change from AVS to AVT or vice versa. So that's how more or less I predicted the questions will be. Or more like, what is the total amount at the end of the year on the income statement? What is the total amount on OCI at the end of the year, right? So those are the type of questions I expect you see if you get passive investment question. Why? Influence investment, friends. Influence is the equity method, okay? Equity method in IFRS or GAAP, doesn't matter, it's the same, okay? So equity method, pay attention. The percentage of the net income usually is positive. So I'm assuming that the positive net income, a percentage of the net income minus the percentage of dividends, minus the amortization of PP&E, property, plant, and equipment. That's the change on the investment value on the balance sheet. Pay attention, it's percentage of net income minus the percentage on the dividend minus amortization of the PP&E to come up with the end value of that account. Typical question that could show up on the equity method, right? If you have to do some kind of calculation, okay? Remember that the dividends decrease the investment in or is influence, but increase cash. Cash go up. So the company takes the dividends of the subsidiary and increase the cash and decrease the investment account on the balance sheet. So it's important to remember that for the equity method. Joint venture. Joint venture is the 50-50. Then we're going to have the only difference between IFRS and GAAP. IFRS gives an option, and you can do proportional consolidation. So 50% of everything of the other company, it's consolidated into yours. Or you can use the equity method, right? Which is 50% of the net income minus 50% of the dividends minus the amortization of PP&E will be the way to update that investment. So joint venture, IFRS allows both. A GAAP must use equity method only. GAAP uses equity method. The only one that have a choice is IFRS. All right. Another thing to remember, under the proportional consolidation, the answer is the same if you use the equity method or 50-50 of everything. You get the same answer. Because it's a simple argument. If you bring 50% of the sales of the other company, 50% of the cost, 50% of the expense, 50% of all the components, it's exactly to take 50% of the net income of that company. So proportional consolidation and equity method will give you exactly the same value as the percentage in the net income. So the equity will be the same, the net income will be the same, okay, the amount. So those questions show up usually on what is the impact on the ratio if the company changes from the proportional consolidation to the equity method. Some ratios will not suffer anything because they are the same value here. Finally, control. Don't, my opinion, again, my opinion, don't expect to do a calculation when you have to do the consolidation of several different accounts. Don't worry about that. This is going to be, in my opinion, a very bad question to ask in the exam because it doesn't measure anything. So it's time consuming. But you're going to need to understand certain things that the impact of using the control approach. So if the control approach, if you don't have 100% ownership, but you have 50% plus one share, you must consolidate everything of the other company into yours. That means that if you have less than 100%, you're going to have minority interest into your balance sheet. That means the percentage of the company that's inside my balance sheet but does not belong to me. That's minority interest. And that would trigger what we call the partial and the full goodwill method. Partial or full goodwill method, okay? The partial goodwill method and the full goodwill method is just that the goodwill, what is the goodwill again? That's level one. Goodwill is the excess price paid when you buy a subsidiary, and then you're going to have goodwill. Now, if you're using the total consolidation method, you're using full goodwill. Means a portion of the goodwill that should be to the minority interest now belongs to you. It's in your balance sheet. Or you can do the partial goodwill method, okay? Or at least know what it is. It's only calculating the goodwill based on the percentage of ownership that you have into that company. All right. This will obviously have lots of impacts on ratios, okay? So make sure that you are aware of this, how these questions could show up on that exam. All right, I have to move on. Pension, okay? I cannot stress here, when I used to take the exam, right? I took the exam level 2, right? And we expect to have FSA, or in that time was FRA, in the first and the second portion. That was the rule, right? You could have FRA in the morning exam and then the afternoon exam, or the part 1 and part 2. So usually, right, the candidates that if they didn't see the pension question on part 1, they would expect to see a pension question on part 2. Expect, right? Because that was a topic that, for some reason, right, maybe become a urban legend. I don't know. We believe that will be in the exam. A lot of my colleagues that teach the content believe that as well, right? So why not, right? Let's imagine that this will be in the exam. What do you need to know, in my opinion, right? I'm expecting you here, what, 4 questions about pension, maybe 5, okay? So there's not many questions you can ask either. So if I were you, I would know the components of the plan assets, the components of PBO, the components of the periodic pension cost, okay? The ones that go to the P&L, profit and loss, the formula of the total pension cost, the topics of cash flow adjustments when you have over contribution, and maybe a question on stock option benefits that talks about the vesting period and the annual expense cost, and maybe with a very tiny little, quasi almost zero probability that the Greek ladder on options will be on that portion. Like if the volatility change, if the gamma change, if the delta change, if the theta change, et cetera, what happened to the stock benefit? I don't think it will be there because this has more chance to be in the derivatives portion of the exam, but it's in the reading. So I just mentioned here. All right. Now I put a little list here for you here to kind of like doing a brain twist or brainstorm, whatever you want to call this. It's all mixed up here, and you should kind of like, okay, which one of those, how do I come up with my total plan assets, right? Which accounts here are present on my plan asset? Which of those here are accounts that are on my PBO, right? Which one of those are on my P&L, okay? Now, I need to stress that this is the most likely question you will face on that exam, this one here. The periodic pension cost on the P&L and the total periodic cost. You need to know that difference, okay? You need to know that difference, okay? The keyword for the problem will be profit and loss or income statement. So if it's there, then only the components of the pension cost that goes to the income statement you need to remember. And the total pension cost, you need to remember the formula. Okay, that's a formula. And that's one of those things that I expect that every level 2 is candidate to know, is the formula of the total pension cost, okay, or also called the economic pension cost, right? And therefore, because I expected every level 2 to know, probably that question will not be there. But anyway, I'm guessing again, so it's important to know here. So is the change in funded status or status, whatever accent you want to use here, change in funded status minus employer contributions, okay? That's a very important formula, okay? There you go. Change in the funded status minus the employer contributions, okay? Don't forget that formula. What is funded status? Be careful funded status, because I've seen a lot of people missing questions, not because they didn't know the formula, it's because they didn't know how to calculate the change in funded status. Be careful. Okay, I need the change in status, the funded status at the end minus the FS in the beginning. Now the FS, the fund status in the end, it's plan assets at the end minus PBO at the end. Get that number? Then do it again. Plan assets minus PBO at the beginning, and then you do one minus the other. That's your change. Okay, and then minus employer contribution. That's the total cost. All right. One word that I think it's important to mention here, I'm just going to put there, remeasurements. Remeasurements. Okay. So make sure that you know what are the remeasurements that we do, okay, on the or the components or remeasurements or remeasurement components. Okay. So the remeasurement components, they usually go to OCI. And they are, okay, the actuarial gain and losses. So actuarial gain and losses, okay, there you go, actuarial gain and losses, okay, and also here the difference between expected return and the actual return, or difference between the actual return, AR, the actual return, minus the expected return, because the logic is simple. If you need to show reality on your financial statement, you need to show what really happened, you cannot put the expected return on your numbers. You have to remove the expected return and put the actual return. So that's called remeasurement. At the end of the year, that's what is done. When the statements will be ready to be published, right? That adjustment has to be there, called remeasurements, right? If that doesn't ring the bell, take a look in the reading. And don't forget, I'm not going to go over here because it's going to take too much time. And I already reviewed with each one of you that have taken classes or did some kind of work with me for learning the topics here. We already covered that, okay? So the periodic pension cost P&L for IFRS and GAAP, make sure you know item by item that goes on each one of them. That's my advice to you, okay? Here it's mixed up, so when you watch, I'm not gonna do now because of lack of the time, but if you watch this video again and you wanna kind of like say, okay, I'm gonna prepare the plan assets, which of those accounts belongs to the plan assets, which of those accounts belong to the plan, the PBO, and which ones belong to the income statement, okay? Reminding you the employer contributions, right? And benefits paid. Where is the benefit paid here? Right? Benefit obligation, right? Benefit obligation, actual gain, plan assets at the end, actual. Okay, so one here that I want to put here that's not there is benefits paid. Okay, the benefits paid is the amount of money paid by the plan assets or paid by the plan liabilities. Which one is that? Oh, there you go. With their benefits paid. Okay, and this will reduce the amount of plan assets and we reduce the amount on PBO equally. So benefits paid belongs to both. So that's why I put in yellow here for you. All right, moving on. Again, if you have any questions, please ask in the chat. Oh, great to have more customers or more, excuse me, more audience. That's great. Okay. Typical question. So components impact on the income statement, OCI. Okay. So you really need to know the components, in my opinion, here. All right. Stock options, very quickly. Remember, the one type of question that you could face is, what is the annual expense cost or the annual expense related to the option benefits granted that year? Answer, is the total annual expense, is the total expense divided by the vesting period. Okay, that's the annual expense related to the stock option benefits. So don't forget that. Could be a question on your exam. The Greeks, again, are the Greek letters that will have an impact on the option price, who could make it more expensive or less expensive, this type of benefit here. All right, moving on. Multinational operations, friends, okay? This one could be one question, maybe two questions here, right? There's not much to ask about here, okay? So what would be, right, that I predicted? Obviously, you need to know when to use the current method, when to use the temporal method, right? So I put it right here for you. The current method and the temporal method. Current method used on the subsidiary is independent and inflation, okay? Look, one thing that I want to tell you is here, we are not acquiring the subsidiary. We are translating the statements of the subsidiary and including in one financial statement, which was the parent company. This is not it looks like a consolidation method, but we're really doing is translating to the parent currency, if is the case, and then consolidating the numbers. So that's a little bit different what you do here, right? So the questions are going to be a little bit different. The question is going to be more on the method of translation, right? Rather than the consolidation aspect of it. Right. Current method, subsidiary is independent. And if there is inflation, right? High inflation, actually I'm going to put here high inflation. Then under IFRS rules, if you have high inflation, you have to use the current method after correcting for inflation losses, okay? High inflation after correcting for inflation losses, okay? That's important to mention here, after correcting for inflation losses. There you go. So only IFRS does that, huh? Only IFRS does that. The temporal method. If the subsidiary is dependent, you use the temporal method, either both methods, IFRS or GAAP, both accounting standards. But if there is high inflation in that country, when the subsidiary country is, there is high inflation, GAAP says use the temporal method, okay? So that's important to know when to use. What else that I found super important, that you really understand if you're gonna have a gain or a loss, okay, on translation, just by taking a quick look on the question. The questions you would say, you don't need to go and do all the calculations to figure out if you're gonna have a gain or loss on the translation, okay? You just need to make sure that you know which method you're using, okay? And the currency exposure, okay? The currency exposure, you will affect monetary assets, okay? Monetary assets, okay? They will, because the monetary assets will be translated using always, doesn't matter which method you're using, monetary assets will be translated using the current method, okay? Only the non-monetary assets under the temporal method, it's correct, it's translated using historical rates. Under the current method, it's all translated using current rate. So pay attention. You will have a gain or loss if you don't use the historical rate. If you have to use the historical rate, don't worry about it. You're not going to have any gain or losses. You're using the historical rate. The historical rate, you don't have any gain or losses on the translation. Only when you go from the historical or the purchase rate, the rate of the purchase, to the current one. So every account that you use the current method to translate the value, it's exposed to currency risk, okay? So only monetary assets are exposed to that, or in monetary liabilities. Never forget that too. Monetary liabilities and monetary assets. Now, by definition, all liabilities are monetary. So here is monetary assets, monetary liability. That one is a mistake. I have to fix it. Just a second. Non-monetary assets. We usually don't have non-monetary liabilities. Oh, I wouldn't even consider that. Monetary assets and monetary liabilities. What are the monetary liabilities? For the effect of the exam, all liabilities. So all liabilities are monetary. Now, what are the monetary assets? Be careful. It's cash, short-term investments, right? Short-term investments, right? And accounts receivable, okay? And maybe inventory, but because be careful with the inventory, because the inventory, the problem might tell you something about it, okay? Because the inventory, it might be using an average rate of inventory purchase, but, okay? But definitely cash, short-term securities, and accounts receivable are monetary assets, okay? Now, what is net monetary assets? And what is net monetary liabilities? Net monetary assets is when your monetary assets are larger than your monetary liabilities. In a net monetary liability, my friends, net monetary liabilities is when your monetary liabilities are bigger than your monetary assets. Then you have a net monetary liabilities. Now the typical question, you identify the company has net monetary assets, right? Now you take a look on the currency, right? The currency is appreciating and the currency is depreciating, okay? What is the impact? Are you going to have a gain or a loss? Okay, you need to know that. So very quickly, net monetary assets, if the currency is appreciating, that's good for you. Okay, that's good for you. There you go. And net monetary liabilities and the currency is depreciating, that's also good for you. Okay, that's also good for you. Okay, I remember when I did I did my master's degree in Canada, university in Canada, but being an American, I had to pay as a foreign student, international student. I borrowed my money in my tuition in the US dollars. And when I translated that to Canadian dollars at that time, beginning of year 2000, the dollar was so strong that the Canadian dollar was so weak that my tuition, my liability in Canada was low. So always remember that if you're from the US, you have an apartment in Canada, right? You want that you have an asset. So you wanted the Canadian dollar to appreciate in value. So that building, that real estate that you have there will gain value. But if you have to pay debt in another country, right? Then you want to make sure that that currency is depreciating because that's in your favor. Okay, that's what it is. So, for example, now we have these digital nomads, right? That's the new terminology. We have this for people like me, actually, right? That doesn't have to live in one place to be working, right? They can work anywhere. What they're looking for, they're looking for countries where the US dollar are appreciating or euro is appreciating and the local currency depreciating, so they can go and live there because they know their expenses will be much less if they make money in the US dollar or euros and spend in a currency that's depreciated, right? So there you go. If you are able to remember those things, I think that would be relatively easy for you to answer questions on multinational operations. Right. Typical questions that I predict here: impact on ratios, and maybe some small calculation using each method, the current and the temporal. Okay, when to use the current, when to use the temporal. I believe that's going to be more or less like that. Okay. All right. So make sure that you know which accounts are translated using historical, which ones are translated using the average rate. Okay. Be careful that cost of goods sold and depreciation, which are accounts of the income statement. Okay, income statement. If it's temporal method, they don't use the average rate, but usually the problem tells you which rate should you use for cost of goods sold and for depreciation and for common stocks, depending on the case of the question. All right. So if this was not enough for you, which probably wasn't, I mean, I can possibly imagine that I cover every single point of that reading here, I strongly recommend you to go back and practice because this has chance to be in the exam. All right, friends, I'm moving on. Okay, I'm moving on now. For those ones here, 12, 13, 14, I'm going to be very quick here. Okay? I'm going to be very quick here. For number 12, financial institution, it's a new reading, relatively new reading. Maybe one question, okay? No more than that. So what are the most important topics on reading 12? The Basel Agreement. Take a look on important points. Basel III, by the way. Okay? And camels, okay? The capital adequacy, asset quality, management, earnings quality, liquidity, and sensitivity. Those are the CAMELS, okay? Now, my advice here is how a bank knows that the capital is coherent. It's called adequate capital. There are some formulas that they use to find that. How do they, what techniques they use to find the quality of the asset that they have in their hands, okay? Or the quality of management of the financial position, and the earnings quality, liquidity position, that's ratio analysis, and some sensitivity test. So I would, if you have the time, I know the exam is this week, but if you have the time, take a look on examples of how to detect the C, the A, the M, the E, the L, and the S. Okay, that's what I would do for you. That's what I would do for you. All right, reading 13, I put here on this color here because I do not believe that this could be a question on level 2. So I'm not going to even talk much about it. Earnings quality, financial statement quality. Finally, reading 14, friends, integration financial statement. Take a look on accruals. Right? How to detect accruals. What's the accruals here? It means the difference between the net income, okay, and the cash flow, okay, in terms of what's money, what's not money received yet. So, for example, an increase in accounts receivable, it's usually an example of an accrual, means the money is not in the business yet, right? Because my accounts receivable are increasing, right? So make sure that you remember that formula here. okay, to compute the accruals in percentage terms is net income minus the CFO minus the CFI divided by the average net operating, not NOI, made a mistake here, NOA, net operating assets, okay, net operating assets. NOI, my friends, is for net operating income. That's what we need for real estate. Here is NOA. The other one is NIA or NIA, right? NOI, NOI and NOA. There you go. So I would revise that if it's still not clear for you. All right, moving on. Corporate issuers now, friends. Corporate issuers. We're arriving at the half of your exam level 2 now. Also, it's a small session, so I'm not going to spend much time here. I'm just going to focus on those ones that are highlighted in the yellow color here, on the yellow family of colors, are the ones that I believe they're more important topics than the ones I highlighted in blue. But that's my opinion again. So let's see. Reading 15 is capital structure. What is important? M&M. M&M is important there. M&M 1, M&M 2. Okay. M&M 1 is the value of the firm. Okay, it has to do with the value of the firm. The firm that borrows versus the firm that doesn't borrow. Okay, the firm that borrows that doesn't borrow, if there's no taxes, the value is the same. If there are taxes involved, you can deduct tax on your interest payments. Well, then the value of the leverage company, the company that borrows, it's higher than the value of the company that doesn't borrow, right? That's valued by what? What is the additional value of the companies that borrow? Is D times TX. Okay, D times TX is the debt times the tax rates. That's how much the company is saving because it borrows money. Therefore, the market sees this as an add value in the company. At least M&M, Mogliani, Miller, deduct, conclude that. M&M 2, the required return by the stockholders is proportional to the level of debt of the company. So that's the famous one that you see, RE equals RO plus RO minus RD times DE. Okay, so I don't know if you need to memorize this formula. I'm putting that one there because it might be useful. Okay, there we go. That formula might be useful. So the only thing you need to see is this D ratio here, debt to equity ratio. If D is increasing, you can see that this whole equation here, the RE will increase. So that's the argument of M&M2. If the debt starts increasing, the return on the equity will increase. All right, so that's important to remember. All right, that's capital structure. All right, DE, D divided by E, it's also the capital, also called capital structure of a company. That's the percentage of debt divided by the percentage of equity, or the value of debt divided by the value of equity. That's the structural capital of that company. All right, friends. 16, I have little chance, in my opinion, is the analysis of dividend and the dividend theories. Dividend matters or dividend doesn't matter. That's what the reading says. Dividend doesn't matter when you can create the dividends yourselves. How can I do that? Well, there are two ways to do that. A company can repurchase shares and make the value of the shares that stays behind increase. That's a way to increase the value of the share. It's a way to pay dividends. Maybe you can see that way. Another way, the dividend, to explain the dividend doesn't matter, is that every time that the company does not pay dividends, you can sell a little portion of your investments and create dividends for yourself, based on the argument that if the company pays dividend, the value of the stock will go down. Well, then if I sell a little bit of my position of a company that has not paid dividend, my position goes down in value. Is like if they had lost value, if the company had paid dividend and the stock price has moved down. So that's the argument for dividend doesn't matter. But there are arguments for dividend matters. Bird in the hand theory and the tax approach. So if the country that you live in charges a high taxes for dividends, then you don't want a dividends. So dividend matters. Dividend matters. I rather be in a company that doesn't pay dividends. So dividend matters. The dividend policy, the company will matter for me. Right? Bird in the hand means I rather have money in my hands today than have to trust that the company will grow. That's why they're not paying dividends to me. So the bird in the hands theory is that, right? So maybe take a look on those two will be enough. All right, reading 17. I would put a mix of blue and yellow here. Okay, I would put like in a more greenish territory, because it's a relatively new topic, ESG, but it has already been included a few years ago. But it's a topic that's in the newspapers all the time. You know what I mean? You've seen a lot of people kind of like talking about this, and that's changing a little bit the investment world and how people invest in stocks, etc. So ESG become very kind of like the topic of the day. So there might be one question there. I don't know. But for reading 17, I expect that you might get, if you get a question, something related to good corporate governance and environmental social influence. So I don't know. Maybe you want to take a look and see how the examples are lined up in that reading. All right. Number 18, I also found very little chances to have a question on reading 18. Maybe one question. It's merger and acquisitions. But I think a big chunk of that chapter is on the defense mechanisms before takeover and after, right? That's why I put the pills here in quotation marks, because you have the poison pill, the poison put, you know, all those ones there. The white knight, the white squirrel. So take a look and see, because maybe you can get one question. Which of the following, give a description and ask which defense mechanism is that? Or which of the following is a preemptive defense mechanism? Right? So that's the reading 18. Now, reading 19, I predicted at least one or two questions. Maybe, right? One entire item set on capital budget. Okay, I expect that. So review the NPV with options, because NPV, you're already being tested on level 1. So it's not going to be simple NPV questions here. Okay, it's going to be NPV with option to abandon, option to expand. Okay, or two projects that have positive NPVs, which one do I choose? You have to use the least common life approach, or the economic annual annuity, the equivalent annual annuity method, right? That one, I believe that's the most common one. Okay, for this one, you have to use the PMT formula on your calculator. Okay, use the net present value is the present value. Put present value. Put the interest rate, put the number of periods, and calculate the payment for each one. And the one that gives the larger EAA is the one you choose. All right, that's corporate issuers, friends. I really hope you do well on this one here, because that's possible to narrow the content, and then you can get here 4 points, 4 to 5 points, right? Because it's going to be one item set for sure on corporate issuers. All right. Let's go to the most, along with FSA, in my opinion, the heaviest, because ethics, although is heavy, ethics is pretty much the same thing as level 1, level 2, and level 3. Equity and FSA, no, right? And equity in level 2 is heavier than level 1, okay? Level 1 is going to be more definitions. Level 2 is going to have much more calculations, okay? So I prepare this one here for you. I believe that again, judgment call here, okay, for the review. Readings 2021, okay, it's more level 1. 22 as well, but 22 you might want to take a look on the Porter 5 forces, if you haven't seen that in university yet, the Porter 5 forces, right? And the the top-down approach. This is level 3, by the way, top-down approach and the bottom-up approach. Okay, top-down and bottom-up, two approaches to selected investments, right? This one you start with in the countries of the world, select a country, select an industry, select a stock, top-down. Bottom-up, select the stock, select the sector, select the country to invest in that stock. So top-down, bottom-up. Bottom-up, you do a comprehensive analysis on the stock. Top-down, you do an analysis on the economy, and then in the industry, and then on the stock. Okay, this is going to be, you're going to be required to know that on level 3. So that will be 2021 and 22 in my opinion. Now, 23, 24, 25, 26, and 27, I predict that this has chances to be there, definitely. Okay, so 23, dividend valuation. What's important to remember? One stage model, that's called the Gordon-Gross model, right? Is the P0 equals D1 divided by R minus G. Excuse me. That's the one stage model. What is the multi-stage model? Multiple stage model, okay? The multiple stage model, right? Several different ones, is for companies that never paid dividend before, and they start paying dividend with different growth rates, the growth rate of the dividends, until stabilize. So a company that's going to pay 20%, the dividends are going to grow 20% for the next 3 years. Then the dividends are going to grow 15% for the next 3 years. Then the dividends will be stable forever at 5%. That's a multi-stage model, okay? I don't think this is going to be there because it's time consuming. You have to do calculation here, and then there, but, okay, never know. Age model, yes, the age model could be there. You have to memorize the formula of the age model. The age model of the dividends is the one on the dividends will decline linearly year after year until it becomes stable. There's a formula that you need to know. It might be that you have to remember DuPont return on the equity, and you might have to remember the ROI times B equals G concept. Return on the equity times the retention ratio equals sustainable growth rate. Okay, that might be necessary here. And don't forget that one here as well, the present value of a growth opportunity. It comes from this formula here. Price of a stock equals the earnings divided by the requirements, okay, plus the present value of gross operation. So usually you're going to have to find the PVGO, and earnings will be given, the required will be given, the price will be given. So I have to do price minus E divided by R to find PVGO. Okay, so that could be there. That's the 23. Yeah, I mean, I strongly believe that will be at least one question on dividends on your exam. Age model, I don't see why not, right? I could even predict that this will be there. 24, it's free cash flow valuation. That's what drives a lot of students, a lot of candidates crazy, because there's so many formulas for the cash flow to arrive on the free cash flow to the firm and the free cash flow to the operation. I only recommend you to know one formula and remember your income statement. Remember income statement here from sales, right? Minus cost and expenses, okay? Minus cost and expenses, right? Minus the depreciation expense, okay? Minus depreciation expense. That's going to be equal your earnings before interest and taxes. Minus your interest expense here. That's going to be equal to earnings before taxes, then to minus taxes here, tax expense, right? And then you're going to get your net income. This, okay? I believe you just need to remember one formula for the free cash flow to the firm and one formula for the free cash flow to the equity, the one that starts with EBIT, EBIT. EBIT, 1 minus tax plus depreciation. Okay, then plus or minus, usually minus net working capital expenditures, net working capital, minus usually capital expenditures, CapEx. That's the only formula I should ask you to remember for that one. Okay, now, but what about the EBIT? EBIT is not given. The EBT was given. Well, then go back to find EBIT from the EBT, because if you don't remember, if you remember this, you'll be able to figure it out, right? If you are very unlucky, then the problem is going to ask you EBITDA. So that's here equals EBITDA. Okay, look at that one. So if EBITDA is given, that's fine. Don't worry. Don't need to memorize another formula. Find EBIT and then replace it on this main formula here. So if you want to remember a formula for the cash flow, starting with EBITDA, If you want to memorize a formula for the cash flow, start with EBIT. You want to find a formula, start with the net income, go ahead. But you don't need it. You can memorize only one and then adjust it according to which profit is given on the problem, right? Which type of profit it's given on the problem. Could be the net profit, which is the net income, net profit or the net income, or could be the operating profit, okay? Or could be also the earnings before taxes, right? The operating profit before taxes, the operating profit, or the operating profit before amortization and depreciation. So if you remember this, you only need one formula. This one here, you need to remember another thing, huh? That's helpful. Free cash flow to the equity, it's after paying the bondholders the interest. After paying bondholders interest, okay? So if I take my free cash flow to the firm minus the interest paid, okay? Because here is before interest. So take that, subtract the interest, okay? Take the interest that you pay to the bondholders, then add net new borrowing. Look at that. Look how easy it gets to memorize the formula for the free cash flow to the equity. Is the free cash flow to the firm minus the interest paid plus net new borrowing. What is net new borrowing? More borrowing or payments of principal debt, right? If it's negative, right, you pay too much, then it's a minus. If you borrow more, it's a plus. But look at that. It gets simple, in my opinion. Memorize those. You only need two formulas, okay? Just two formulas. And then remember, right? Remember your components of the income statement. All right, friends, so that's free cash flow here for you, okay? Remember, right, that once you find the cash flow, you have to discount the cash flows to figure out the value of the company today. All right, price multiples. Yeah, that could be a question there. So make sure you know the difference between a justified leading price multiple and a justified forward price multiple. Know the formulas and know the formula of the enterprise value and know how to use it, comparison, okay? So the formulas I'm talking about here is the PE ratio, okay? The PE ratio formula, right? You know, the price divided by E, right? That you have to do that 1 minus B divided by R minus G, okay? Those are the formulas that I'm talking about, asking you to remember here, that I'm suggesting you to remember. Now, what is justified? Justified means use a formula to find the PE ratio. So justified PE ratio is this. Now, what is a justified forward PE ratio? It's P divided by E1. That's forward. What is a leading PE ratio? It's P divided by E0. Well, because it's P divided by E0, I have to multiply my 1 minus B, 1 plus G. So look at that. Justified means use a formula. Leading means use E0. If you use E0, you have to multiply the numerator by 1 plus G. If you use forward, then it's P1, PE1, right? And the PE1, you do not need to multiply by 1 plus G, okay? So justify leading, justify forward, okay? Make sure you remember that. All right, residual income, friends. Residual income, yeah, could be one question on residual income, right? Not an entire item set. I don't believe an entire item set on residual income. You'll be very unlucky if this happens to you. Make sure you remember the clean surplus relationship, and make sure that you remember the formulas, the single residual income formula, okay? That's RI divided by, remember, if I'm talking about residual income, I'm talking about profit. If I'm talking about profit, it's RE minus G. Now, cash flow, my friends, free cash flow to the firm, I'm talking about the entire firm. So then I have to discount by the WACC, weighted average cost of capital. Free cash flow to the equity, that talks about equity. Equity, I discount by the required return on the equity. So be careful with that too, right? Which is the discount rate you're going to use, right? On those, for each one of those cash flows that you use. All right, now that's the single residual. Now we have the multi-stage residual model, is the one that has the terminal value. So you're going to have residual income this year, residual income, residual income, residual income, terminal value. Then you have to add, bring all to the present and see what is the value of the company, okay? Multi-stage. And remember that fading factor. If the problem says, if the company has a fading factor, a factor of, okay, if this factor is lower than 100%, that means that the residual income is not persistent. What is residual income? Residual income is net income minus equity charge. But residual income could be also ROE minus RE. Okay? Net income is profit. Equity charge is the minimum profit that the stockholders want. One minus the other is your residual. Hopefully it's positive. ROE, return on the equity. RE, required return by the equity holders, by the stockholders. One minus the other, it's residual income. So the residual income model, remember, the one that has the ROE minus R, okay? You have to remember that formula, okay? Also, in the same token, EVA, okay? EVA or EVA and RI, okay? What is the difference between EVA and RI? Well, EVA, right? It's NOPAT minus WACC times invested capital. Now, RI, okay, is the net income minus RE times the equity. Okay, so be careful with that. Okay, capital includes debt and equity. WACC is the appropriated discount rate, or the appropriated required return for total capital. But equity alone, I required only the stockholders' return, so RE. So this residual income, and that's economic value added. What is NOPAT? Okay, NOPAT is EBIT times 1 minus tax. That's NOPAT, net operating profit after tax. Okay, so again, okay, NOPAT goes here for EVA. Okay, technically, if you discount EVA year 1, 2, 3 at the WACC, and if you discount RI, residual income, using the RE, you usually should get the same value, right? If you're using EVA or RI, okay? Things that could show up on your multiple choice questions on an open question rather than a calculation question. Right, residual income, friends, okay? So take a look on that. Finally, reading 27, maybe one question. And I would say maybe on the comparable beta, on asset-based valuation, or the excess earnings method. That's one the participants have a tendency to forget, the EEM. Comparable beta, I put it here. Unleveraged beta. So choose, you see, you're doing private company. Private company don't have beta in the market. How do I find the beta of a company that I want to calculate the expected return, for example, using CAPM, right? So if I want to use CAPM for the private company, okay, where is my beta for that, right? You have to use a comparable beta. So go to the market, find a comparable beta for that company, and leverage that beta by dividing that beta by 1 plus DE times 1 minus tax, okay? That's your unleveraged beta. Then you're going to re-leverage the beta, right, by multiplying by 1 plus DE, 1 minus TX. Reminding you that this is DE of the company that you found the beta, and this is the DE of the private company that you want to calculate the beta. That could be in your exam, okay? All right, asset-based valuation, just to remind you the pros and cons, the asset-based valuation. For example, it doesn't work if the company has a lot of intangible assets, okay? So asset-based valuation is worth to take a look. Excess earnings method right here. It's a way to find the residual income. It's the net income or the earnings, right, minus a return, asked return on the working capital, minus a return asked on the fixed assets. Well, if I subtract and take the earnings, subtract those two returns that I expected, that's the residual income. And then from the residual income, you can calculate the value of the company, called excess earnings method. I don't know if this is going to be in there with high probability. Okay, I don't think so, but I put it there just to cover my review here, just in case. My friends, you know, it's a review, so I have to keep on going. There's no question. Well, everybody's still here. Congratulations. You know, that means you really want to pass this exam. I don't blame you. It's going to be, look, once you earn the charter, you're, you know, especially those, I mean, if you live in the United States, there's too many charter holders in the US. Now I'm actually pointing up to my students that are not in the United States, not living there. Most of you are living in countries where the CFA charter, it's not that popular yet, but will be. It will be. Take a look in the US, take a look in Europe, take a look on the number of CFA charter holders in those countries, right? So especially for those living in the countries where the CFA charter is not popular, you have a great future ahead of you. So it's worth the effort that you're doing here, right? That you're taking here. All right. And for the Americans, they want to work overseas, right? Well, there you go. Your CFA charter is going to be a great way for you to guarantee an interview if you want to live anywhere in the world outside, right? If you're tired to live where you are, you want to now live somewhere else. Again, the charter will help you to get at least an interview in another country, for sure. All right, friends. Now I should have said not for sure because I don't know, but most likely. All right, now I am on fixed income. Then I have derivatives and alternative investments, which I combine in one review, and then portfolio management, and then we're done. Okay. All right. So in blue, it's what I think that has less chance to show. In yellow, what I think there's more chances to show to appear in the exam. So let's see, the 28 and 29, the readings, is the interest rate dynamics. Then we're talking about spreads, right? So we're talking about the TED spread, right? The I spread, right? And all the other ones. So one little thing, I spread, right, is the swap spread. That one we usually to find credit risk of corporate bonds. The TED spread, my friends, which is the government United States Treasury bill yield compared with the LIBOR, okay? That TED spread is not used for corporate bonds. It's just to see the risk level of countries. So the TED, so maybe now you need to know the difference between those spreads, okay? But I think there's low probability. The interest rate curves and the shifts on that curve. So we're talking about here, right? A parallel shift. What is the name of a parallel shift? Okay, a parallel shift is the same as changing level. Okay, so changing level. So I would probably take a look, and again, right, if you have the time and disposition, motivation. So changing level, changing the slope, and changing curvature. What is this? What causes a change in slope? What changes in curvature, right? What is important to know here, right? So changing level as a parallel shift on the entire yield curve. Well, then what do I do? Which risk measurement I use? You use effective duration. So that's what I think you should be careful here, right? So for each one of those changes, right, you need a certain measurement of duration. So the changing level, right, is usually you're going to use effective duration. And a changing curvature, you're going to use the key rate duration. Okay, so I think that's worth it. It's important maybe to make that association. So if you have the time, again, I don't predict it much weight on this reading on your exam, but you know, if you want to take, they have the time, your disposition, motivation, go ahead and take a look on those shifts. Could be level, slope, or curvature. Could be also steepness, right? That's the changing slope. Right, 29 I found arbitrage-free framework. The only thing that I could imagine being in the exam is that you're going to have to demonstrate that you know how to use the tree, the interest rate tree, okay, to compute the value of a bond. That most likely, but that's time consuming. So that's why I don't think a problem like that will be. And maybe a question on the arbitrage-free, or not arbitrage-free, no, on the interest rate models, right? The equilibrium and the arbitrage-free. Maybe take a look and see which ones belong to which category. That's more or less what I think that you could expect from 29. Now, 30, 31, and 32, I predict that most of the questions on your exam will be from those readings, okay? Option bond, bonds with option, the valuation, value of a call option, a put option, okay? Maybe, again, you have to demonstrate you know how to use the tree, okay? So review that if you want. Make sure that you understand what is the Z spread? What is the option adjusted spread? How do I determine if the bond is rich or the bond is cheap according to the OAS spread, right? So a bond is, is rich or cheap means the bond is being sold for more than it should, for less than it should, right? So what is the OAS spread? Well, if you know the definition, you'll be able to answer those questions. The definition of the OAS spread, very quickly, is a amount that you're going to add into the yield to maturity to make the bond price using the tree to be equal to the market value of the bond. So the OAS could be positive or negative, okay? So if you have to make the model, your bond that you just calculated, right? You calculated at $100, okay? And that bond has to go to 101 because that's the market price, okay? Then your OAS is gonna be negative, right? Imagine here that I have a YTM, okay, equals 4% or 5%, okay? Then I have to add a negative number on that YTM to lower that YTM to bring the price to go up. So I would put a negative OAS, a negative one, to bring that. So that's a rich bond. It's a rich bond because the OAS is small. So OAS small equals a rich bond. And the opposite is a cheap bond, okay? So that could be a question, very quick question. You're gonna get a little table, bond A, B, C, OAS for bond A, OAS for bond B, OAS for bond C, which bond is rich, which bond is cheap, right? Quick, and if not quick question, if you know, you answer in 10 seconds. If you don't know, you probably have to guess. That's gonna be a problem. All right, and revise duration, effective duration formula, convexity formula, and understand what is the convexity adjustment. A convexity adjustment is a value, it's a formula that you add into the duration to come up with is most likely the impact on the bond price due to a change in the interest rate. This little graph here, it's helpful because here showing you the duration or the convexity, excuse me, of option bonds here, with bonds, without bonds. So look at that. The option-free bond is the one here, is this curve here, okay? That's not dotted or dashed. But the callable bond is the one that has a negative convexity right there. Look at that. This is negative convexity, meaning the callable bond behaves like a normal bond until one point. After that point, when the interest rates are going down, the bonds start having negative convexity because all investors know if the interest rates keep going down, that bond is going to be called at this predetermined price. So that bond will never have a chance to go up because that bond is going to be called. That's negative convexity, okay? Now, the put bond only has positive convexity. So the put bond is going to have a convexity. It's going to be more like a letter C than the option-free bond. So take a look on this, the convexity, the negative convexity, the put convexity, right? Because that could be helpful for some of the questions you face. All right, friend, 31, I also believe you could face a question on reading 31, credit analysis model, the credit models. What is the difference between the structure format or the structure model, the reduced format, okay? So the structure, very quick, structure format, the model predicts credit default or credit risk using option approach, using probability. Reduced format used an external view. So a structure format is an internal view of the company. So the company A issued a bond. The structure format is going to take a look on the company that issued that bond to determine the credit risk of that company. Now, the reduced format will not use the company risk. You're gonna use the market risk. What's going on in the market, in the economy, those variables, and then we'll predict the credit risk of that bond. The reduced format, therefore, is easier to use, excuse me, because you can get pretty much all the variables in the economy, in the market. The structure format is sometimes you don't have the variables that you need to compute that, to use in that model. So take a look on those, the pros and cons of the structure and the reduced format could be a question. And take a look on that CVA, the credit value adjustment, credit valuation adjustment, right? Which is a value that you're going to subtract from the price of the bond to come up with a bond that has the price reflecting credit risk, CVA. For those that don't remember the CVA, you start with the price of the bond at time 1, the price of the bond at time 2, the price of bond at time 3, right? Then the price of the bond at time n. That's what we call the value at exposure. Then you're going to compute the loss given default. Excuse me, you're going to put probably the recovery amount, the amount that you will recover, then the probability of default, and then one times the other is your loss given default. Take the present value, add, and then you have your credit valuation adjustment. I don't believe you're going to have to do all of this, but I believe you need to know what they mean. The loss given default, probability of the default, what is the CVA, and know how to use it. Okay, so take a look on that if it's still not clear for you. Finally, my friends, on 32 is the credit default swaps. One thing that's super important understanding on the credit default swaps is that when you sell credit default swaps, friends, okay, you buy risk. When you buy credit default swaps, you're selling risk to someone else. Okay, if you understand this logic here, then that would make sense. That would be easy for you to answer questions. When would you profit by buying a CDS? Because see, we're talking about now speculation. We're talking about people trying to make money on a CDS when they don't need the CDS. Okay? They're not even on the bond market, but they want to make money on CDS. What they do, they're going to spot companies that have low risk, then low credit risk. Okay, if that company has low credit risk, and I'm a trader, I am going to sell, I'm going to take and sell CDS. Whoever has a bond on a company with low credit risk, come to me. I'm going to sell credit default swaps for you. Go ahead, come here. Why I'm doing that? Because I'm betting that the credit risk of that company is so low that that company will never default on their payments, and therefore I don't need to honor that credit default swap that I just sold. The person that bought the CDS will never exercise that CDS. So you buy, to buy risk, you sell CDS, sell risk, you buy CDS. So how can you make money? Well, you sell CDS for low risk company bonds, and you buy CDS on high risk company bonds, and you can make a profit in that way. So it's a profitable trade here, right? Credit default swaps. Okay. Reminding those of you that expected 2 hours, I'm probably going to need another half hour to finish. If you have to leave, go ahead. This will be recorded, and I will send the link to everybody. Okay, but if you could stay another half hour, I would say that's what I need here to finish. All right, moving on to derivatives and alternative investments. Small portion of your exam, but equally a danger, right? It's a danger topics here, because that's topics that a lot of candidates are not 100% comfortable because usually they don't work on this field here, right? Most of folks taking the CFA exam are in the equity market, right? So again, right, that sometimes can be difficult because of that. All right, what is in blue, in my opinion, actually here there's no blue and yellow. Here is in blue is the alternative investments, and on yellow here is the derivatives. Okay, so you only have 2 readings on derivatives, and you have 3 readings in alternative investments. Let me go backwards here. Alternative investments, okay, in my opinion, private equity is the one that's going to show up there with more certainty. If I have to choose, real estate next, commodities third. Of course, I could be completely wrong here. I'm just predicting. But if I'm right, then on private equity, please make sure that you understand valuation of private equity. They usually have to do the IRR, computing the internal rate of return on the private equity. The waterfall distributions of private equity, how to compute the return, right? That's what I just said, and the structure of a private equity. Okay, at least know that. Okay, so private equity here. Those are the points that I found very important. Net asset value before distributions and after distributions. What is that? Net asset value is the assets minus liabilities of the fund, usually divided by the number of shares because you have the NAV per share. What is DPI, RVPI, TPI, right? So DPI is distribution paid in. RVPI, okay, is the residual value paid in. And one plus the other is the total paid in. So the question is, a DPI of 0.5 is better or worse than a DPI of 1.2? Okay, those are the questions that's what you need to be able to answer. Which fund is doing better for the limited partner? The fund that has a DPI of 0.5 or a fund that has a DPI of 1.2? The fund that has a DPI of 1.2, because the distribution, it's higher than the investment paid in. So it's like D divided by paid in. So if I paid in a certain amount and I got more than that amount, that number is going to be above 1. That's good. But if that number is below 1, means I haven't been, I paid more than I got it back. Okay. So those are important to understand, how to interpret those, because if this is in the exam, I don't think you're going to have to calculate NAV or DPI. No, you're going to have to take a look and decide which one is the best fund, 1, 2, or 3, based on those. So if this is not clear, make sure you review. What is the J curve on the private equity? All private equities usually exhibit a J curve, meaning that you're going to have to pay, and then it turns around and then start making money after that, right? So the J curve is usually present. It's usually the curve of the private equity. Just put there just because. Now, what about if you get questions on commodities? Well, I predict it could be on the raw yield, the convenience yield, on the collateral yield. I'm missing an R there. The collateral yield, okay? So make sure you know each one of those, right? Make sure you know what's contango, and make sure you know what's backwardation. Okay? Make sure that you know the insurance theory, right? No, insurance hypothesis, right? The storage. Okay? Oh, not storage. Okay? To explain contango and backwardation. So you might want to take a look on those theories, the insurance theory, the storage theory, right? The liquidity theory to explain contango and backwardation, okay? But that's going to be that would be on the category of difficult questions in my opinion. Finally, real estate, which again, I don't think there's much chance to show up because the calculations for the real estate are time consuming. The net operating income, right? Using the cap rate approach to find the value of real estate. So go over that. And I forgot to put here, but I'm going to put now, that you know the difference between FFO and AFFO. AFO and FAFO. Those are cash flow measurements for real estate investments. Funds from operations, adjusted fund from operations. Make sure you know the difference. What's the AFO with FAFO? What's the difference between FAFO and AFO, right? It's a cash flow measurement. So you take the NOI plus depreciation, but the AFO is adjusted for some expenditures and for free space, especially if you're looking for a rental income real estate investment. Right. So that's, again, I believe the private equity will be the one that's with more chances on that exam. Private equity session there. All right, friends, let's derivatives now. Derivatives, I wish I could predict it, but we need to make a judgment call here in terms of calculations, right? Because a lot of questions could be appearing about the structure of a swap agreement, the forward rate agreement, right? But could also be calculations. I predicted maybe 1 or 2 calculations you're going to have to do here on those 4 questions that you're going to get, 4 or 5 questions you get on derivatives. Okay. Remember, there's not many questions you can ask here. Okay. It's 11 item sets. 11 item sets on part 1, and you're going to have 11 item sets, right, on part 2. So if you're seeing one item set will be on derivatives, but because of the weight, you should not expect more than, we have 44 questions, 44 questions here and 44 questions here. So what are you expecting here? Maybe 4 questions on the derivatives, maybe 5, okay? So not much, because it has a small weight compared with FSA and others, right? So I'm predicting 1 item set on derivatives, 1 item set only in alternative investments, right? With, I don't think it's going to be, again, I wish I could say that, but I hope it's not going to be super complicated questions. There's no room for that, right? So assuming that, that not going to have those crazy calculations, going to take you several minutes to do, then what is important? Well, valuation, return, and the structure of derivatives. So you could get a question on the forward and future contracts. I don't think so. Why not? Because this will be question for level 1. What else can I ask you on level 2 that I have not asked you on level 1 for forward and futures? Market to market, that's question for level 1. What is a forward agreement, the pros and cons, the difference? It's all questions for level 1, okay? You can ask me the market value of a forward contract. Yes, but then probably will be on FRA, forward rate agreement, okay? Probably you probably could get, if it's a valuation question, I don't think you're going to get on a future contract. That's what you have to demonstrate on level 1. Forward contract, especially forward rate agreements, then yes, you have to understand valuation. For the FRAs, look what I put here. Find the forward rate at T1 or whatever time you are, and then you're going to have to compute the present value of the payoff after the expiration, and then find the value of the forward rate agreement, right? I would definitely revise that if you're not comfortable, okay, if you have not practiced. Now, knowing what is a 3x9 FRA means, that's level 1 question. 3x9 FRA, it's a level 1 question. Now, level 2 questions on FRA, it's valuation, market to market of a FRA. So review that, okay? All right. And swaps, swaps, yep. I'm predicting 2 questions on swaps on your exam, 2 questions, okay? Now, computing the reference rate at T1 using Z factors, I found too much. Computing the price of a swap using Z factors, I found that's going to be taking too long. Maybe, unless if they give you the Z factors, then you have to remember that formula, right? That the price, the reference rate of a swap, which is called the price of a swap at time 0, means initiation, it's equal 1 minus the last Z factor, which is Z factor. Z factor is the discount rate, right? The discount factor, using the discount rate of that particular year. And the sum of all Z's. okay, divided by the sum of all z's. That's how you compute the price of a swap, okay? Z factor. Don't think this will be there. I don't think so. Even though, because I believe every level 2 student candidate will know that, okay? So again, so swaps, I'm expecting something more on the equity swap, okay? On the equity swap, I think there has more chances of all the swaps. Equity swap, I think has more chance. So I'm gonna make a comment here on the equity swap. Try to understand the equity swap, okay? Since we have Brazilian students on the here in the audience, as part of the audience, I'm gonna use the example here, USA and Brazil, okay? So let's say you are an American investor, but you saw a stock here in the Brazilian market. You saw that stock there, and you really want to buy that stock, ABC, but you don't have access to that stock. Then you ask someone, a dealer in Brazil, to buy that stock for you, okay? And then you create a swap. You're going to promise the dealer, okay, that you're going to swap the payments. Which payments? You promise a fixed rate. You promise a fixed rate to the dealer. Okay, and the dealer promised to pay the return, okay, pay fixed rate to the dealer, and the dealer pays the return on the stock. Okay, and that's it. That's the swap. So what is the catch here? What is the thing you need to pay attention here? Is that the dealer, it's renting, it's receiving a rent because it bought the stock for you. So you have to pay the dealer some rent for it, okay? The dealer doesn't want the stock. The stock doesn't belong to the dealer, it belongs to you, I mean the returns, until the swap contract finished. So the dealer cannot have any losses related to the stock. That's what the caveat for the equity swap arrives, is that the party here, the investor, sometimes will have to pay twice. We have to pay the fixed rate and the negative return on the stock that the dealer in Brazil bought it for this example for the American investor, because the dealer did not buy the stock for the dealer as a person, but for the investor. So the dealers just need to get the fixed rate. That's the payment of the fixed rate. If the stock lost value and the stock is in the portfolio of the dealer, the investor has to pay that difference. So pay attention on the equity swap, okay? The equity swap is that one that you use it when you don't have access to an investment somewhere else and you need an intermediary for you. That intermediary, the dealer usually, is the one that's going to receive a fixed rate and is going to pay the investor the return on the stock. If the return is negative, the dealer will receive that along with the fixed rate payments. All right, that's the equity swap. I don't believe that you're going to have to do a calculation of the value of the currency swap. The currency swap, it's more, and by the way, currency swap is tested on level 1. The characteristics of the currency swap, the risk of the currency swap, is the only swap that has swapping of payments at day 0, right? But other than that, I believe that if there is a calculation, it will be on the equity swap. That's my prediction. All right. Moving on here to contingent claims, which is options. Reading 34 says contingent claim. That's options. That's what it is. That's why the structure format of credit analysis use options on the model, because option is a contingent claim. Contingent means I may or may not exercise. A forward commitment is a commitment. I have to do it, whatever I decided on day 0. Contingent claim, I bought an option, but I decided to exercise or not. My prerogative. That's a contingent. Contingent is contingent to something, and this is a firm commitment. All right, what do you need to know for options? Well, then is that story here that everybody probably is ready, right? The Greeks, you need to know the delta, the gamma, right? You need to know the whole, the risk-free rate, the impact of the risk-free rate on the option value, vega, and theta, right? The ladder, Greek ladder. Those are the Greeks. So time decay, volatility, interest rate, that's the change on the delta and that's the change on the price of the option due to the change in the price of the stock. And the gamma is the change on the delta due to the change in the price of the stock. Make sure that you're comfortable with that. Make sure that you know what is the delta of the call option. Make sure you know the delta of the put option, okay? Make sure that the delta of the call option goes from 0 to 1, okay? The delta of the put goes from -1 to 0, okay? -1 to 0, it's a negative delta, okay? All right, gamma, it's always positive, always higher than 0, okay? And the put gamma and the put call usually the same, okay? Because the change is measured in positive ways. The risk-free rate, right? Increase the value of the call, decreases the value of the put, okay? Decreases the value of the put. Vega, volatility, increase the price of the call, increase the price of the put. Time decay, as the option approaches expiration, the value of the call goes down and the value of the put goes down as well, right? Approaching to expiration. So make sure that this is clear for you, okay? What else that could be there? The Black-Scholes-Merton model, maybe. Some characteristics of the Black-Scholes-Merton model. So what it is, constant volatility, okay, that volatility. That's important to remember, the constant volatility of that's one of the inputs on the Black-Scholes model. And the main concept of the Black-Scholes model, which is the price of the stock today, okay, minus the strike price, the present value of the strike price, price and value strike, okay, one minus the other. S0 is today, right? The price of the stock today. One minus the other is the price of the call option. So that's what the Black-Scholes model does. It takes the stock today minus the present value of the strike price. One minus the other should be the price of the stock, the price of the call option today. But the Black-Scholes model has to assign probabilities to the price of the stock in the stock price. So that's why the proper model has S0, right? N of times, right? Times N of D1 minus, right? The present value of the strike price, right? Times N of D2, okay? So what is N of D1 and N of D2 on the Black-Scholes model? It's just the probability of the stock price go up and down, right? And the price, strike price. So I create, this is like simulation. Excel can do that. It keeps guessing random normal distribution values here until it keep doing several times until you get the value of the call option. That's the Black-Scholes model right there for you. Now, the complicated part is compute N of D1 and the N of D2, right? Has that crazy formula with the square root of the volatility square root of T. Anyway, so that would be too much. But I think the main idea of the Black-Scholes model, I think you should know. Okay. Delta hedge, all right. So let's talk about the delta hedge here, okay? So delta, right, is the N of D1 on the Black-Scholes formula. But what is delta hedging, right? Delta hedging is just, if you had, you say you have the delta, okay, and you have the number of shares. So if you're hedging, okay, let's say 100 shares of stocks, and that stock has a delta equal 1, the call option has not the delta of the call, the delta here of the option, right? The delta call equals 1. Then that means to hedge 100 shares of stocks, okay, to hedge 100 shares of stock, right? Then you should hedge against 100 call option, 100 call options, right? So long, short, short, long, 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 depends on the strategy. What you need to remember is that the delta call equals to 1, means that you need exactly the number of shares, right? Exactly the same, 100 calls and 100 shares to hedge. If the delta is less than 1, because the delta will never be higher than 1, the delta is 0.5, then you're going to need 50 calls to hedge 100 shares. That's the idea about the delta hedging. It's if I have a portfolio and that's exposed, I need to hedge that with call options. What do I do? All right. So just remember that the delta of call multiplied by the number of shares determines the number of calls that you should buy or sell into that portfolio. Also reminding you that the delta is the change. Let's put that one here. Delta is the change, right? The change in call price due to the change in stock price. Okay, that's the definition of delta. But on the Black-Scholes model, the delta can be seen as N of D1. All right, that's the delta call, by the way. And since I opened this door, what is the delta put for you not to forget? The delta put, okay? Well, remember, the delta put is always negative. Goes from -1 to 0. So, it's 0, but below that is all negative. So, be careful. It's not 1 minus N of D1. Because if you do 1 minus N of D1, you're going to get a positive number. Okay? You have to do the other way around. N of D1 minus 1. So, be careful in case you have to do that calculation for the exam. N of D1 minus 1 is the delta put. Okay, there you go, right there. Right, D2 is for the strike price. So D2 usually doesn't have a place on delta hedging or anything related to delta put or delta call. Right, the D2 is the D1 that's going to be there. All right, delta call, delta put. All right, there you go. And that's it. Well, I wish I had more time for portfolio management. Like, I'm going to extend because I'm not going to kind of finish, right? Halfway there, but I'm moving to portfolio management, which I have here separate for you. And that's going to be the last topic that I'm going to review. Okay. Again, I'll thank you for those that stayed until the end. I know it's in your interest, right? But as someone that's providing a live, it's nice to have an audience here, right? It gives me kind of stimulates and motivates me to keep on going. So thank you for that. Back here. Now look at that portfolio management. That's a heavy. Look at that. 1, 2, 3, 4, 5, 6 readings. Okay. Now in blue are the readings that I believe that not going to have chances or high chance to be in the exam. Backtesting, simulation, and economics of investments. That has to be the marginal propensity to consume affecting investments, right? The risk premium, the rich people, what I call the rich people, right? The person that has low marginal needs to consume, usually is the person that has a lot of money. Those ones are willing to change the risk premium of the assets based on that marginal propensity to consume in the future. So that's what the reading 42 is. I don't know how many questions should be there. I would say 0. Backsetting simulation is just like stress test. Do I use a scenario analysis, or do I use sensitivity analysis to see what's happening with my entire portfolio of bonds? Okay, so that's backtesting simulation. Now, ETFs is a new reading, relatively new because it wasn't on my exam, and if I believe now when this started was 2018, 19, I don't remember when this started, right? But it's relatively new reading. The exchange trading funds, maybe 2017, I don't know. Okay, but if this shows up in the exam, which I believe it could, make sure you know the characteristics of the exchanging trading funds, the pros and cons, why they're tax efficient, right? Why they're liquid, and how it works with that authorized participants, the APs of the ETFs. Make sure that you really know how to redeem shares of an ETF, how to issue new shares on an ETF. Okay, so that's reading 38. 39 is the multi-factor models, and yeah, then you have chance to have at least one question there. Why not? The shown that you understand how to use the macroeconomic model, that they use the fundamental model, right? All of those models that have more than one factor. That's what we call multi-factor model, okay? Do you remember your French fame model, right? The FF. What about the Pastor Limbaugh model, right? Remember that one? Okay. Do you remember the risk premium using the Ibbotson chain? Huh? The one that has 1 plus inflation, 1 plus the gross and the earnings per share. Remember that? Okay. Ibbotson. I think that's Ibbotson chain. Forgot how to spell correctly, but you know, so Ibbotson, please forgive me for that. From a French and the Pastor Limbaugh models. Okay. Make sure that you review those. And the macroeconomic model, the one with the surprises. Okay. The macroeconomic model is very interesting. The return, it's equal to the expected return. Okay, the expected return plus surprises. Okay, plus surprises. So always remember that in the macroeconomic model, the expected return is the intercept. The surprises are the factor model. So it's just like X1, not X1, but it's like this, 3 times the GDP plus 2 times the earnings per share minus 1 times the inflation. Okay. Now, GDP, earnings per share, and inflation are surprises on the GDP, the earnings per share, and the inflation. Because if there are no surprises, GDP is 0, 0 surprises, 0 earnings per share, 0 surprise, 0 surprise. So expected inflation equals 3%. Real inflation or actual inflation equals 3%. The surprise here is 0. Okay, if the surprise is 0, right here under inflation, I would put a 0. Okay, that's why if I have no surprises, I only get left with the expected return. Okay, so make sure that review that. Fundamentals has to do a fundamental model, right? It's not an example, the one they use earnings per share, they use the gross rate, or you know, the turnovers of the company, use like accounting numbers or relationships to compute the expected return. That's the macro model. I definitely expected, I would expect if I were you, a question on that. All right, continuing. Market risk measurements. That one is VAR. Okay, VAR, value at risk. So review your VAR. Make sure you know the definition of VAR. Make sure you know what is a conditional VAR. Okay, the difference between the conditional VAR and the VAR. Okay, the conditional VAR is like that. The condition is given that. Right? That's what conditional probability is like. Given that the economy is booming, what is the expected return on the stock of company A or B or C? Right. So the conditional VAR is more or less that. Given that the company achieved that minimum expected loss, what is the maximum it could be, right? What is the worst it could be? That's a conditional VAR. Okay, should I know how to calculate a parametric VAR? No, a parametric VAR, again, look, why, if I cannot say no too strongly. I can say maybe not, because a parametric VAR, right? Parametric, as you've seen on level 1, right, is using standard deviation, right, in average, the mean and standard deviation. Okay, so that's what a parametric test is. It's to computing the value at risk, right, giving a 95% chances, right. That's what would be a parametric VAR calculation, right. In a 5% interval, 5% confidence, right, with the standard deviation attempt, right, what would be the value at risk, the value at risk? So I don't think so. I wouldn't expect a calculation of VAR. I would expect an open question related to VAR, characteristics, difference, definitions, that type of thing. even if you go to the mock exams and the chapter problem, there's not too many calculations of the VAR there. Okay, there you go. All right, continuing here. But again, it's my opinion, and I want to stress that, okay? And definitely this one, reading 43, I predicted that you get at least 3 questions on active portfolio management, okay? The active portfolio management laws. Then reading 44, I do not predict a single question on reading 44. Why not? Because trading costs in markets, it's an entire reading, in much more details for level 3. So I believe, that's me again, I believe they introduced reading 44, trading cost in markets, right? The market order, stop loss order, what is the best execution, what is the average execution price. This is level 3. And you will see questions, in my opinion, there. So I don't think you will see here on level 2, but that's me. That's just me. Said that, let's finish our review with this, which is a very important topic on portfolio management. One important reading, we're reading 43, is the active portfolio management. I strongly believe that will be questions related to this there. So make sure that you know the following formulas. Optimum Sharpe ratio of a portfolio, okay, is normally the formula is SR square equals SRB square plus IRP square. I actually did it, that would be the variance of a portfolio, right? But the optimal Sharpe ratio of a portfolio is the square root of the Sharpe ratio squared, Sharpe ratio, the benchmark square, plus the information ratio, the portfolio squared. Don't forget that formula, okay? That means the optimal Sharpe ratio of a portfolio, okay? Once you have the optimal Sharpe ratio of a portfolio, right, then you can move to the next step, which is computing the optimal level of active risk that manager should take. That's another formula. Information ratio times the standard deviation of the benchmark divided by the Sharpe ratio of the benchmark. Okay, that's the level of active risk. Okay, and then there's the question: what is the weight? What is the weight of the active of the risky asset? Weight of the risky asset in that portfolio, right? How do you compute the weight of the risky asset, right? Then you're gonna take, right, your active risk, excuse me, the optimum active risk, optimum active risk divided by, right, the optimal active risk divided by your level of active risk, the actual level of active risk, That would give you a number that's higher than 1, or it's a number that's lower than 1, okay? If this number is 1.2, that means you have to invest 120% of your money on the risky asset and negative 20%, mean borrowing, on the risk-free asset, or the low-risk asset, or the benchmark, if is the case here. Now, if this number here, this optimum risk divided by the optimum, it's less than 1, let's say 80% or 0.8, then put 80% of your money on the risk portfolio and 20% on the benchmark, okay? That's one of the calculations of the weight. It could be a question on your exam. So those little formulas here, you have to have it. You have to have those, right? Even if you have to arrive, this is what do you call here for you, a strategy, let's say. You don't need to start your exam on ethics. You can start your exam on any topic you want. So start on portfolio management, right there. And then, you know, you're going to get a piece of paper in the exam, write it down. If you remember those formulas, write it down, all those formulas in that piece of paper before you start the question. I don't know, right? If you want to do that. If you remember very quickly, you're going to lose a few seconds, but that might give you the peace of mind of not having the problem of remembering those formulas if you get too stressed with the exam, That's one suggestion here for some of you. Each one knows the personality that you have. Therefore, you should adjust that personality. Are you an over-anxious person by nature, by personality? Well, do something about that, right? Are you a calm person, you know? Then, okay, perfect. So each one has a personality, right? Doesn't mean that one is better than the other. It's just personality. We don't choose those things, right? We're born with those things most of the time, right? With the type of behavior. All right. Two other formulas that's important. Information ratio equals information coefficient times the square root of the breadth. That's the basic fundamental law of the portfolio management. Information coefficient times the square root of the breadth. Breadth is the number of uncorrelated trades made by the portfolio manager during that period. That's the breadth. You don't worry about having to find in the breadth. It's going to be given on the problem if you have to use that formula, in my opinion. Now, the expanded formula is TC times IC, so transfer coefficient times information coefficient times the square root of the breadth is the information ratio. Reminding you all, the information ratio, it's active return, excess active return, divided by active risk, okay? Excess active return, right? Or active return, if you just want to keep short, divided by active risk, okay? That's information ratio. That's when you know, that's what you use to measure the performance of a portfolio manager, okay? That's looking for active, that's doing active management. There you go, active return divided by active risk, that's information ratio, okay? That's important to remember. All right. Now, why is the basic formula doesn't have the TC? Well, it does, except that we imagine transfer coefficient being equals to 1 for a unconstrained portfolio. So unconstrained portfolio is the portfolio that has short sales, that has all different techniques, derivatives, etc. And an unconstrained portfolio, the assumption is that the transfer coefficient will be equal to 1. Then it reduces the formula to that one. There you go. And on that's summarize everything here, and that's important that you get. That's on your reading, right? This is not exactly the only reading because, you know, I had to make one here because I don't want to use the material for the CFA because I don't have copyrights on those. So, but try to understand this. Now, level 3, friends, level 3, then you're going to have to know this much more details. But not level 2, just understand what is the portfolio construction. The portfolio construction is selecting the weights, selecting active weights. That's transfer coefficient. So you want to associate those words, portfolio construction with transfer coefficient, active weight. So what is the transfer coefficient? Is the ability to choose the right weight, right? To right weight to be multiplied to the forecasted return, the alpha. So if I forecast high alpha associated with a high weight, I'm going to make a lot of value added for that portfolio. That's what's written here. Okay. Now, level 3, you're going to have to worry about how to compute that, but not here. Here, just need the definition, okay, or the understanding of how this triangle works. Down here, signal quality, friends, signal quality, it's information coefficient. This has nothing to do with the weights. Nothing to do with the weights. So what is the signal coefficient? Is the ability to forecast and realize what I forecast. That's signal. So I could put Home Depot or Lowe's again on my portfolio, right? Home Depot and Lowe's should cut me a check for this video. So look at that, Home Depot and Lowe's, right? Well, I'm not going to put both. I'm just going to put HD. If I selected HD and AD was the winner, right? My signal quality is good because I did security selection properly. So remember here, right? Transfer portfolio construction is one thing. Security selection, it's the signal quality. So we have security selection. It's part of your IC. In portfolio construction, construction as part of your TC. Okay, so that's I'm stressing this because this could be questions or multiple choices, now open questions, no calculation questions, that might be important for you. Say, now I remember, this has to do with the portfolio construction, it's transfer coefficient, so I know exactly what to do if I remember that. Okay, so active weights, the correlation, the proper way to say this is the correlation of active weights and forecast return determines the transfer coefficient, and the correlation of the forecast returns with the realized returns, that's information coefficient. Okay, that's calculating that correlation you're going to need for level 3. You're not going to need to calculate the correlation here for the level 3. Okay, for those doing the ecosystem, there is a question on the ecosystem when they show you how to calculate the transfer coefficient, when they show you how to do the information coefficient on the correlation of each one, don't even bother practicing that problem. This has zero chances to be in your exam, to compute those correlations. Forget it. Understand the definitions of each one of those components. All right, friends. Okay, in 44, I predicted that, if you want to take a look, obviously, if you have the time and motivation, go for it. But for those that are on time constraints, I would skip this one here. Okay, even if you have traded before, if you have executed trades before, this should not be a concern. All right, so almost done here. I'm actually pretty much done. Just one more time. Those are all the readings that you're going to face on your exam this week. Of course, most of those readings are not going to show up as a question in the exam, but some of those will more than one question. So make sure that this is clear. This video should be available for seeing by tomorrow. I'll be able to send the link to all of you once this is posted. Okay, it's going to be a link, and then I'll send to everybody. Friends, if you have any questions, please stay. I can spare 15 more minutes for questions, right? If you need to leave, that's fine. That's totally fine. The review is done. I finished. Okay. Of course, it's a review, so I wish I could say, just do the review and you pass the exam. You will not. Okay. You most likely not. That review alone is not going to be enough. But I hope that's my 2 cents here to help you guys to, cover some of the empty or the blurry areas, right? The clouded areas of some of those topics for you. Okay. All right, so if you want to stay and ask questions, go ahead. The others are dismissed. Good luck on the exam. You can still contact me until the date of the exam, or even after if you want, but I don't know why would you. But after the exam, I would like to know how you did it, if you can share that with me. But if not, good luck on the exam this coming week. Really, it's my intention that you pass that with flying colors. All right, let's see. Okay, thank you. All right. Okay, so then we conclude. We're going to conclude here the live. I'm going to stop recording, and if you have any questions, you can ask the others, you can leave. So that's it. Thank you again for staying to the end, and I really hope this was helpful for your studies and for your... Okay, there we go, stop.